My name is Zach, and this is Dividend Data. Now, it's been a pretty crazy week in the stock market. The meme stocks have returned. GameStop, AMC, all led by Roaring Kitty. We'll get into this. So we've had multiple days of crazy trading volumes, stocks going up 60% in a day. This recent surge in meme stock trading is one example of how the stock market in many ways can be a casino. Many short-term traders are just gambling, and it is completely divorced from the reality of investing, which we talk about all the time on the channel. And it's an interesting duality how the stock market can be this pathway for long-term investment into quality businesses with real value, and at the same time can be a gambling parlor where people are trading on prices day to day. So in today's episode, we're going to touch on that very topic. Of course, I'll dive into the news around GameStop stock, but I'll also be talking about day trading and buying based on technicals more generally. And I thought of no better time to bring up this topic, given that Jim Simons just passed away this week. He's a mathematician and physicist who many say that he solved the stock market. His hedge fund Renaissance Technologies averaged 60% annual returns, and his methods had basically nothing to do with investing. On top of that, I'll cover what happened in my long-term stock portfolios throughout the week. Now let's roll the intro. It all started with a meme. On Sunday, May 12th at 8 p.m., Roaring Kitty posted this photo. Now, this is a meme signaling that you're going from laid back to engaged. You're in, you're playing. And that single photo got 26.5 million views, which is absurd. Now, who is Roaring Kitty? This was the guy who originally found the opportunity to do a short squeeze on GameStop stock. He got massively popular online, and the Wall Street Bets community on Reddit was eating it up, and they were fuel to the fire. And this caused all the madness around the meme stocks that I'm sure you remember from 2021. However, this guy disappeared 3 years ago. He has not posted anything, and I'm assuming he got filthy rich. And frankly, I am just amazed by the influence this guy had with this one post and coming back. On Monday, GameStop stock went up 74.4%. On Tuesday, the stock went up another 60%. That is 179% in 2 days. And many people made far more than that by trading options on the stock. However, on Wednesday, GameStop is down 18.8%, and it's down another 10% after hours. So it might be over, but who knows? Now, originally, Roaring Kitty actually had a thesis around GameStop stock. He recognized there was over 100% short interest, and he thought there was an opportunity to squeeze. And he thought at the time they were overly bearish on the stock, and he fundamentally did not think the company would go bankrupt like all the short sellers were assuming. And if you remember his iconic house interview, there was the quote, "I like the stock." And he did. And I don't think there's anything wrong with what he did. However, this time around, Roaring Kitty provided zero research or thoughts or an investment thesis for why GameStop stock would be a good buy. He didn't even tweet about the stock. He has not mentioned anything. All he did was post this, and since then, every single day, every few hours, he's posting movie clips and memes related to it and building hype. And each of these are getting millions and millions of views on X. Just look at these. This is crazy. He is still doing this. It's been multiple days now. He's still doing it. And just the memes and I guess his clout coming back online has caused the stock to surge. Now, it seems like it's dying out, but I don't know, and I'm not making any bets of which direction it will go. And a similar thing happened to AMC, which is the other big meme stock, up 135% and then down 20% today. This is just crazy. And I bring this up to discuss the point that sometimes the stock market can just be a gigantic gambling casino. And day-to-day price swings and adjustments can often have nothing to do with the actual underlying businesses. GameStop is a terrible business. I mean, by every dimension, it's an awful business. Yet the stock can be completely divorced from reality at times. Much of the stock market is a casino. You have things like meme stocks, you have human emotions, often in a bipolar manner, which can lead to massive swings, often unfounded in the underlying asset itself. You have day traders betting on price swings in various stocks, funds, commodities, currencies, crypto coins, and whatever new financial instrument that Wall Street thinks it can make money money on. You got people trading leveraged options, blah, blah, blah. There is a lot of short-term gambling going on, but you can use that as your opportunity. And today I'm going to discuss 2 ways that provides an opportunity to investors. And to do that, I'm going to explain 2 different paths that you can follow. One path is that of the long-term investor who owns businesses. And for that case study, I'm going to use Warren Buffett. And I'll explain how he uses this short-term thinking and crazy market movement and gambling to his own advantage. But the second path is that of a technical trader. That would be someone who actually engages with the gambling and wins. And the best example of that is someone who just died, Jim Simons. His hedge fund, Renaissance Technology, has outperformed Buffett, albeit at a much smaller scale. Although both of these involve the stock market, they are completely different things. And I'll explain which path I choose to follow and why. Let's go. So I'm going to start with Jim Simons because he represents the most positive and best technical or algorithmic trader that has ever existed. His company, Renaissance Technologies, is fantastic, and they are the gold star in the industry. Their flagship medallion fund has posted annual returns of 68% gross and 40% net of fees over the past 34 years. And if you want to learn way more about how that company works and Jim Simons' whole history, I recommend listening to this podcast from Acquired, which is a fantastic podcast in general. They do like 4-hour deep dives on companies and their entire history. And I listened to their episode on this, and it's great. Although I'm using Jim Simons and Warren Buffett as 2 different case studies, there is one clear thing they agree on. It's that the market is not efficient. There are opportunities everywhere. Let's listen to Jim, and then I'll interject with some of my thoughts.
There's something called the efficient market theory, which says that there's nothing in the data, let's say price data, which will indicate anything about the future, because the price is sort of always right. The price is always right in some sense. But that's just not true. So there are anomalies in the data, even in the price history data. For one thing, commodities especially used to trend, not dramatically trend, but trend. So if you could get the trend right, you'd bet on the trend, and you'd make money more often than you wouldn't, whether it was going down or going up. That was an anomaly in the data, but gradually we found more and more and more and more anomalies. None of them is so overwhelming that you're going to clean up on a particular anomaly, because if they were, other people would have seen them. So they have to be subtle things. And you put together a collection of these subtle anomalies, and you begin to get something that will predict pretty well. The system, as it is today, is extraordinarily elaborate. But it's not a whole lot of, it's what's called machine learning. So you find things that are predictive. You might guess, oh, such and such should be predictive, might be predictive, and you test it out in the computer, and maybe it isn't, maybe it isn't. You test it out on long-term historical data and price data and other things, and then you add to the system this if it works, and if it doesn't, you throw it out. So there aren't elaborate equations.
So Jim's firm is a collection of various PhDs in physics, mathematics, and statistics, and computer science, I suppose. They were very early in taking a mathematical approach to analyzing the technicals around stocks, commodities, and currencies, and publicly traded assets. And through their innovations in machine learning, they were able to be predictive about different opportunities in the market. And this yielded great returns, but there were constraints around this system.
The prediction part, but the prediction part is not the only part. You have to know what your costs are when you trade. You're going to move the market when you trade. Now, the average person will buy 200 shares of something, and he's not going to move the market at all because it's too small. But if you want to buy 200,000 shares, you're going to push the price. How much are you going to push the price? How are you going to, are you going to push it so far that you can't make any money because you've distorted things so much? So you have to understand costs, and that's something that's important. And then you have to understand how to minimize the volatility of the whole assembly of positions that you have, and be so you have to do that. That last part takes some fairly sophisticated applied mathematics. not earth-shattering, but fairly sophisticated. It can manage a certain amount of money, which is rather large, but it can't manage an enormous amount of money because you're going to end up pushing the market around too much. So it was kind of a sweet spot as to how much it's reasonable to manage. Therefore, it would never grow into some behemoth which would take everybody out and you'd be the only player. I mean, well, of course, if you were the only player, there'd be no one to play against. There are limitations, at least the way we see it.
So obviously, their approach has worked fantastically, but there are limitations in that they have to limit the size of their moves because then they'll move the market themselves and they'll actually reduce or completely eliminate whichever edge they have found in their models. So there's actually an advantage in being a smaller player in these kinds of trades. And it's for that reason that Renaissance Technologies has not taken any additional capital from investors in decades. You just keep compounding and then distributing out their gains. Their current approach doesn't scale to something that would be hundreds of billions or trillions of dollars. But what we really need to be thinking about here with Jim Simons is that he's the example of a quantitative hedge fund that actually does a great job. And that is a thing that exists in the market. This isn't a day trader that's, charting and creating their resistance lines and all of that. These are incredibly smart people building predictive models, and it does work, but it takes a lot of work to get there. A key point is they have massive amounts of historical data they backtest on, and this is something that the average Joe can't easily do, at least right now. Who knows, with the advancement of AI, maybe we'll all have our own little Renaissance Technologies that can just trade the market. But we're not there yet. So Jim Simons and Renaissance Technologies is one case study of how to take advantage of this large publicly traded stock market with, crazy people and massive price action and gambling. And it's a respectable example. Even Warren Buffett and Charlie Munger, who are going to be case study number 2, even they respect Jim Simons. And here's a clip of them talking about it.
What do you think of quants? Jim Simons' Medallion Fund has done 39% net of fees for 3 decades, which proves that it works. Will you consider hiring a quant lieutenant in Berkshire to work alongside with Ted or Todd?
Well, I'll say no to the second part, and I'll let Charlie handle the first part.
Well, that's rather interesting. The leading quant fund did fabulously on the short-term trading. They found little algorithms that worked to make them, they had predictive value, and as long as they kept working, they just kept doing it, as long as the money kept coming in. When they got to using the same system, just to finding some little algorithm and trying to do it mechanically for long-term stock predictions, the record was not nearly as good. And in the short-term stuff, they found that if they tried to do it too much, they destroyed their own advantage. So there was a limit on the amount they could make.
But they were very, very smart.
Yes, they got very rich.
Very, very smart.
And very smart and very rich, yes. And very high grade, by the way.
Yeah.
Jim Simons.
We're not trying to make money trading stocks.
Warren Buffett is not a trader. He's not a quant fund. He invests and owns businesses, which is an entirely different ballgame, and in itself can be a vector to create great returns and wealth in the stock market. And this gambling casino of a stock market creates opportunities for this type of investor as well. Berkshire Hathaway stock since 1965 has had a compounded annual gain of 19.8%. That beats the S&P 500 with dividends reinvested at 10.2%. And this is over many, many decades. That kind of difference means Berkshire had a 4.3 million % gain compared to 31.2 thousand of the S&P 500 with dividends reinvested. So this is a huge opportunity itself. But what's interesting is that Warren Buffett, when he was initially learning about investing, he was into day trading. He would do charting analysis and all of this, but it wasn't until he came across the book, The Intelligent Investor, that he realized looking to the fundamentals of the business was the key, valuing the business itself, not predicting what the stock market thinks or will do in the short term based on price.
I started buying stocks when I was 11. I've been reading every book in the library on it. I loved it. I could tell you history of finance and all of these things. Got very interested in technical analysis and charted stocks and then all kinds of crazy things. Hours and hours and hours, and tried shorting, and I just did everything. And then when I was either 19 or 20, and I can't remember exactly, I looked at this book and I saw one paragraph and it told me I'd been doing everything wrong. I just had the whole approach wrong. I thought I was in the business of trying to pick stocks that would go up. Chapter 8, I think it was, of The Intelligent Investor. Whether you call it a light bulb, whether you call it, a moment of truth, whatever it may be. That happened to me in Lincoln. I mean, it changed my life. If I hadn't read that book, I don't know how long I would have gone on looking for head and shoulders formations and 200-day moving averages and the odd-lot ratios and a zillion things. And I love that kind of stuff. Except it was the wrong stuff I was looking at.
And this is the light bulb moment that changed Warren Buffett's whole investing career. Understanding that a publicly traded stock is a partial ownership stake in a business and it should be valued as a business, and that you can value that business independently is the key understanding. And it brings you to that next key point where this crazy stock market casino can help you, actually. It can be your friend. It can bring you opportunities. And in this next clip, he addresses it from an idea in The Intelligent Investor called Mr. Market.
The beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. Ben Graham writes about it in chapter 8 of The Intelligent Investor. Well, chapters 8 and chapters 20 are really all you need to do to get rich in this world. And chapter 8 says that in the market, you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And
the meme stocks are today's psychotic drunks.
And he will do very weird things over time. And your job is to remember that he's there to serve you and not to advise you. And if you can keep that mental state, that all those thousands of prices that Mr. Market is offering you every day on every major business in the world practically, that he is making lots of mistakes. And he makes them for all kinds of weird reasons. And all you have to do is occasionally oblige him when he offers to either buy or sell from you at the same price on any given day, any given security.
Mr. Market is here to help you, not to advise you. So when you see things like GameStop stocks surging or AMC, that's not advice to get in. You shouldn't be following that. However, there will be opportunities where a great business is trading at a discount for something that is probably not deserved. And it happens all the time. And as we get to my portfolio, it's a collection of various businesses that I think are high quality. And many of them I bought at times where they were at a deep discount in the market. For example, ExxonMobil was one of those during 2020. I have a 243% total return now on that. People thought oil companies were going under. That was not going to happen. Some of you think Starbucks fell recently undeserved, and I did buy some myself, although I'm not extremely bullish on it. I picked up Tesla stock a few times at great prices, and I bought Microsoft at a great price in 2022. So let's just do a little update overall on my portfolio. The current value is $224,000 with $139,000 invested. That's an $85,000 unrealized gain, 61.1% total return. Here you can see all my different stocks. I just got paid a $67 dividend from EPD. I'll be getting an Apple dividend tomorrow of $12.70. But again, let me just repeat the key lesson of this week's video in that the market is here to serve you, not to advise you. You don't have to buy, and you can wait for the great opportunity. Mr. Market is a psychotic drunk who loves to gamble on meme stocks. And that's fine, they can do that. Some people will make a lot of money, and some people will hold the bag and lose a lot of money. But you don't have to participate. I'm not participating. Sure, I have some individual stocks, but you could easily just invest in the S&P 500, hold long-term, reinvest your dividends, and you will do great. And that's really the lesson here. So I might do a final checkup on close of market Thursday and see how my portfolio changes, if I buy anything. I'll also do a little update on what happened to GameStop and AMC. See you then. All right, guys, so it's Thursday after market close, and my portfolio's current value is $223,000. It went down 0.13% on the day. Total return at 60.88%. Nothing that crazy, really. If we check in on the meme stocks, GameStop is down 30% today. So that's a continued decline from the recent surge. AMC is down 15.33%. So that is also a continued fall from the recent surge. But there was some interesting news in the investing world. It was just revealed that Warren Buffett's new big buy is Chubb Limited Limited, the insurance company, ticker symbol CB. That stake is now valued at $6.8 billion, or 1.8% of his public stock portfolio. This has actually been some pretty big news, and the stock is up 4.71% after that came out. On top of that, Chubb just declared a 91-cent per share quarterly dividend, which is a 5.8 increase from the prior dividend of 86 cents per share. This adds to their history of long-term dividend growth, actually at a higher rate than previous. They've been growing at about a 3% compound annual growth rate. But this is an extremely safe dividend with a low payout ratio, similar to many insurance companies. Now, do I find this buy that surprising? No. Warren Buffett's big into investing in insurance companies. He owns many of them outright, such as Geico. So insurance is in his circle of competence as an investor. Earnings growth has accelerated and it's trading at a pretty good valuation. But I don't think this means you should be going all in on Chubb stock. This is really not that significant of an investment considering he has $180 billion in cash on hand. If you watch my video where I go over the highlights from the recent Berkshire Hathaway annual meeting, then you'll know that he's mostly just putting his money into treasury bills right now. Other interesting news, I guess, is Cracker Barrel stock, which I like Cracker Barrel, the restaurant. They just decreased their dividend by 80.8%. So that's a huge drop off. Stock is doing terrible. The business looks like it's declining, but I do like the restaurant. Thank you for watching this week's episode of Dividend Data. Check out our merch store at shop.dividenddata.com. You can get this hat plus some Buffett Munger 2024 merch. And of course, go to dividenddata.com if you want to use my portfolio tracking and stock research tool. Select the monthly plan and enter the coupon code TRIALMAY, and you'll get to use it for free this entire month. Thanks for watching.